Um, Good morning, everybody. Thanks for joining us. I'm David Naylor. I'm the industry practice leader of financial institutions at Marsh. I'm going to be hosting this. Just want to run through a few of the usual housekeeping stuff, which everybody's probably well aware of in the remote world, but we're running for just under an hour, and we've set this up as a fireside chat, hence the fire behind me. And we're going to look at the current issues in the world of cyber risk, cyber insurance, the insurance market, and buy side as well. Questions and answers are very much needed to make that work. Please put those in the Q&A tab at the bottom and we'll pick those up. I'll be putting those to Brian. We'll be answering those where we can. And I won't be crediting questions. So if you want to ask anonymously, fine. If you don't, then I won't be crediting questions to anybody. Microphones have been muted centrally, and that's it, I think. About time to go. The structure we're going to try and follow is to look at the FI, the insurance side, the sort of regulatory world, and what the bad actors out there are up to, and have a think at the end about some emerging risks and look at some crystal ball gazing. But it's fireside chat, so we'll quite possibly jump back and forth. So welcome, Brian. Perhaps you can introduce yourself and kick off.
Sure. Great. Thank you, David. And appreciate you having me here today. And for everyone joining this, I think it's going to be an interesting chat with David and I having some conversations before. But before we jump into it, just a little bit on my background. So 14 years in cyber, 2.5 years here in London. So we're going to take some perspectives from the US as well as the UK, because we know that looking at financial institutions, they're global in nature, especially with how the impact might be. And we'll dive into that a little bit. But primarily been on the broking side, 12 of those 14 years, 2 years on the underwriting side. Currently the UK cyber leader for over here in the UK, and then also the acting cyber leader as well in the UK. But I think before we start off in terms of questions, I want to level set just in terms of, what is cyber risk? What does it look like to every single different type of industry? We're not going to be able to dive into the minutia of the cyber risk for all different size organizations on this quick update right now, but we're going to dive into some of these different details around different financial institutions and what they're looking at. But cyber risk can mean anything to different people depending on where they sit, both within their organization as well as what the organization subsector might be within financial institutions. So really, it could be data leaks, it could be business interruptions, it could be data breaches, it could be human error, human vulnerability. We're going to hit on a lot of these things today, particularly how it affects the financial institutions and in terms of what that might mean to each of you that are listening to this call. But I think that's a great level set to just say we're looking at all different areas. Cyber risk, when we talk about it in this case, is more to the commercial side and what it means. We're not talking about the loss of Wi-Fi or anything else in a personal home, although we will touch on how that is affecting from the COVID world that we're living in now.
Thanks, Brian. Obviously, there's a lot happening in this world. For financial institutions, operational resilience is very much part of the agenda, ties into emerging risks. And Europe is, and our regulators are looking at cyber resilience as part of that. There's draft guidance out from the ICO for consultation, and this framework is being adapted. Basel is being looked at yet again for financial institutions and what that means. And obviously, some of the old Basel provisions are really quite old now and don't really work in a digital world. So from an insurance perspective, when you're looking at proximate cause of an event, how does that tie to very old Basel classifications? Digital operational resilience, the EC launch of that in February, and a great stat I came up with when I was searching online. It's a little old, 2017, but financial institutions global financial institutions face a new regulatory rule every 12 minutes. So that's something to be identified, analysed, embedded, and acted on every 12 minutes. So the pace of change is incredible, and a lot of this is around the world of cyber digitization. And when we look at particular issues and talk to clients and talk to our contacts, then digitization of the business is absolutely on the agenda, driven by the pandemic. I'm sure you've all seen the joke about who's driving a digital strategy. Is it coronavirus or the CISO? And everybody is trying to move ahead and take advantage. It's also on the cyber is now a standard entry on FI risk registers. The risk appetites are being set and discussed. It's a standard reporting piece on the risk reports to the board risk committee, standing agenda item. So it's front and center. There are some organizations that actually have separate cyber risk committees that report to the board risk committee as well. So there we are, right in the middle of the storm almost. Just as a high level, we tend to, as an industry, divide up financial institutions into traditionally, 4 or 5 areas: the sort of banking area, commercial retail banks, the insurance sector, the investment management sector, including the hedge funds, the asset managers, and the wealth managers, etc. FMIs, the financial market infrastructures, the exchanges, etc. And then the sort of new kid on the block, the digital crypto fintech area, which I'm sure we'll be talking about. So I'm going to ask Brian to just have a quick think about each of those areas one by one, and just what does it mean for that sector. So if the first on that list, Brian, was banks. Just sort of an overview of the world for banks at the moment from a cyber perspective.
Yeah, absolutely. And banks continue to be the #1 target from what we're seeing, mainly from bad actors and what's happening because of the data that they have. So when we're breaking down, and I was talking about the cyber risk and where we level set, we look at 2 main themes: data and technology. So what is the potential for data vulnerability that would be breached or compromised in a sense from the systems and everything else? And when we also look at the technology and potential business interruption, I mean, commercial banks and retail banks have all of these included. And so that's why the cybersecurity that is being invested in these banks is much higher than any other industry or even subsector of financial institutions when we go into the next 4. But with banks, the amount of regulatory and oversight changes, as you mentioned, happening supposedly every 12 minutes, it hits them the most in terms of what's happening globally, and being in most cases multinational in nature. There are multiple different regulatories that have to be followed, different privacy laws that are coming into play. And when we look at the cyber insurance world, we're also trying to play catch up with that on the regulatory side in terms of what's going to be the next thing that gets put into a cyber policy. But for banks, really the risk is coming from the customer relationships that they have with their customers and how they would actually protect their reputational damage. It's not just, are we going to lose this and what's the cost going to be, but what's the external loss in the next year or 2 from that reputational damage.
Reputational damage would probably be a bit of a thread. What about, the insurance sector, insurance companies? Everybody's trying to take cost out of the system, increase the reliability of processes. How's that going to impact on the cyber risk profile of the insurance sector? Yeah,
and there's multiple layers to the insurance side as well. So if we look at, in our world, David, we have the direct insurers, then we go into the reinsurers, and then we go into different types of insurers across different regions where they need to have wholesalers. And so it could be inclusive of brokers as well. But dealing with just the insurers that are looking at this in the insurance side, the amount of data that they hold is more impactful than what the business interruption might be. So when we start looking at the information of individuals, if we're looking at life insurance or personal type of insurance, but if we're looking at the commercial side, what is being transferred from workers' comp, from other types of submissions that they're receiving from brokers, or any other type of evaluation of the risk to put some type of risk transfer on there. So really we look at the data side of it for the insurance side. Now we're becoming more digitized, as you mentioned. So we start to get more reliant upon the technology. So the business interruption is starting to creep in there. At this point, we can still pick up the phone and do a lot of our business in the insurance side, but I think that's going to start changing over the next few years.
And that digitization piece is another thread, but it ties very much into the investment management sector, the asset management wealth manager sectors, where a lot of effort to simplify and automate back office. We've got black box trading, we've got the RPAs and the growth of AI, and what's the line between them is seems to be debated. And AI ethics is something that a number of regulators are looking at. And so a question about asset managers already in investment managers is, let's have a look. Do you see the segment developing in cyber world, and what's the most crucial cyber risk related to investment funds and management? And I think that's a good time, sorry, to just flag that, for those who think that cyber is just all about data and personally identifiable information, it's not. And again, Brian's mentioned that, but it's really worth flagging.
Yeah, and with investment management or asset managers, this is crucial from the network interruption side, because we're looking at the losses of the gains that could potentially have been had if it was up and running. Interesting enough, when I was an underwriter previously in my previous life, we were looking at the investment exclusion on cyber policies. So I know we're going to dip into insurance a little bit later, but it's a good thing to point out when we look at the investment side of things is if your network goes down and you're not able to make a trade or move funds in a way that's supposed to going to be changed by the market, and you're going to have a gain off of that change, there is a loss there. But if you were not able to move the funds in a timely manner due to a network interruption from a cyber event, we look at what the losses might have been. There's no gain from that. You actually gain from having the network interruption. So it plays on this, what can be covered, what cannot be covered. And I know that having spoken to a lot of different investment management and asset managers, this is a hot topic that's coming up, and it's no surprise that one of our first questions coming up is about this particular subsector of the financial institutions. And so really the crucial part of this is, as we implement more AI or even machine learning to try and track the market and use that to the best for not only the customers, but our own companies as well, is to make sure that we also have that protection around that network interruption. And one thing I always use as an analogy is you build a building and you put the sprinklers in. You don't build the building and then decide, do we need sprinklers or do we not? So the same thing should be going as you're implementing this new technology, and never more important than investment management.
That sort of ties into the traditional insurances or investment management as well, because the concern here is, what's the aggregating event? The insurance market on a loss is very much looking at, in our terms, what's the proximate cause? What's the root cause analysis? What was the error? And is, from an insurance perspective, is that one error or more than one error is an aggregation question, as we call it, which is quite fundamental. And if you've got RPAs or AI or black box trading, then suddenly you need, as an investment manager, to consider whether that could be one error or whether it could be multiple errors per client. And so we've had some clients look at, do we attach an insurance risk transfer at a catastrophe level at, say, $1 billion of excess, and buy insurance above that because the aggregated event is there, and that very much ties into the cyber piece as well. Financial market infrastructure was sort of next on the list, and the fear of a network outage or the platform being down is the one that everybody jumps on. Although trading houses, exchanges say there are backups. There's the ability to go and hedge loss elsewhere. There's ability to trade in other ways, and paper trading can eventually be there, but it's a problem. How do we see this at the moment, Brian?
Yeah, and I think this is, we've talked with a number of different financial market infrastructure companies, and when we look at the network interruption, there's so many backups to make sure that that's not going to be an effect on the global, like the whole entire world, actually, in most cases. When we start looking at the confidential information that's being passed back and forth, there is some concern in terms of who's going to be able to get a hold of it, who's tracking that, who's able to see it. So we start looking at that particular side of the data breach side of things, and data leak, I guess, is the better way of putting it. So we're not concerned in the traditional cyber, as most people look at it, as personal information, but the confidential information, which would then influence others on making decisions. Similar to that too is when we look at the integrity of that information being passed back and forth. So we start looking at data integrity as a large scale concern if that information is being passed back and forth. And in some cases where we've seen it with the banks, with the man in the middle attacks, are these transactions that are coming back and forth through these financial market infrastructure companies accurate? And testing that out, and this is where we start getting into maybe our next part of on the list of industries or subsectors, is blockchain and how that might be helping or hindering some things in terms of how everything's working together.
That's a great intro to the next section, which is the sort of the digital world, the cryptos, the fintechs, which in many ways aren't a sector in themselves. And I know, a number of people in the sector say that there's no such real thing as a fintech because finance and tech have been together for 100 years. I know the smaller fintechs coming through are seeing better ways to do things that large organizations either can't see or can't implement. But that sector, fintech, cryptocurrencies, the digital tokens, that's a very interesting area for cyber. And is it a cyber issue? And where's the loss going to be?
Yeah, and we're actually struggling with this in the cyber world with the insurance side, with how cryptocurrency has been added into cyber policies, and the demands for ransomwares have been paid typically out through that cryptocurrency. So it's starting to leak into that side of things in terms of what the risks are to every organization. But I think what we've seen is going from paper money or whatever the material might be, depending on the country, to credit cards, to debit cards, and now we're looking at cryptocurrency and crypto wallets and purses. It's changing how we're exchanging information, being more and more reliant upon the technology. We have our own separate division within Marsh that focuses purely on the cryptocurrency underneath our species division, because it is such an advanced type of technology that's being utilized more and more often, with more different types of currencies coming out in this space as well. I completely agree with the fintech side of things. We've been implementing technology for now at least a couple decades, if not longer. I think the most recent one that everyone's looking at across the globe is the application side of things. So when we start looking at the fintech world, I think it's the combination of not only the commercial banks and the retail banks, but also who they're partnering with, which then falls into that fintech side of things. It is creating a larger risk because, which we'll get into a little bit later, I know, is the digital supply chain and how that's being handled from handover to handover.
Absolutely, yeah. I mean, looking at risk, cyber risk, and we've tried to define it and where we look at it and mention each sector. But how do you actually manage this in a business? What's the key sort of things that perhaps from a business perspective you want to look at? But what's the underwriter going to expect you to have done and in place already anyway?
Yeah, and I think before you even get into that is just talking about what are the threats that they're looking at too. So a lot of the times I will have a conversation with different types of organizations from different industries and say the human vulnerability is definitely something we should talk about, which we'll dive into in a second. But for financial institutions, because they have such a big target on their back and they're so public and very well known, 91% of the threats to financial institutions are coming from outside or bad actors. And this is coming from the Verizon data breach investigation report in 2020. But if you keep in mind, this is a breach report. So when we start looking at the network interruption side, that human vulnerability definitely comes into play. And that's where we have to be concerned in how everyone's being resilient and how the culture of the organization. So when you look at managing the risk, you have to understand the risk it is for your organization. So if we're concerned as a financial institution about the network interruption, depending on how you are as an investment manager, or if you're concerned about the personal data, taking two different ways to manage it is the way we have to address it. So from the human vulnerability side, I'd say you have to manage a culture first. And I think this may apply to even all different sides of things, including the data breach. Are your employees willing to protect the company and do what's best from a digital or a technology standpoint to make sure that nothing's going to be leaked out from their perspective or from their point of view? When we look at today's lockdown and this year's pandemic, the culture is something that's very difficult to control because we're in this mindset, having gone into another lockdown in the UK, everyone's a little bit just drained. We're not as coherent in terms of looking at the cybersecurity. It might be the first thing that slips. Yes, I'll click on this link. It's not a big deal. Who cares? Or we're looking at Christmas emails that we might be getting now in terms of what the retail savings might be on one purchase or another. So you're starting to get into this managing the risk by a culture of the organization, and how that starts is from the top down. So when we start looking at what the boards were doing 3 years ago, is there maybe 25% of the boards, according to the McKinsey research, were having more than one meeting a year. If we look at it in the last report, 95% of boards now are discussing cyber security more than 4 times a year in the financial institution sector. It's a good and amazing change over 3 years, because it does start from the top down. So when we start looking at how the boards are looking at it, it trickles into how management's looking at it, and then it goes into the training. And from that training side of things, we look at the supply chain, knowing the footprint, and also knowing your vulnerabilities, as I mentioned before. So when we start looking at how we're going to train our employees on looking at phishing emails, how to send information back and forth, and even in some cases, I know most organizations will have some type of encryption email when sending external emails. So all of this will apply around that culture perspective.
And how's that playing out at the top level? Who's taking these matters to the board risk committee? What's the reporting line? Is it coming through the CRO? Is it the CISO? Is there a standard?
There used to be. There's a changing in the standard, particularly between the CISO and the CIO at this point. We're starting to see the CIO basically be the person that's sitting at the board. And this is not the same for every organization. But one good thing about the changes that we've seen is there's always someone that has a cyber risk background sitting on the board now, or the majority of them. If not, they're getting significant amount of time, similar to what I mentioned in terms of the stats, with having more than 4 meetings for 95% of the boards for financial institutions. It's crucial to have someone sit on that board to make sure that there is no filter in some cases. Because if you have someone going from the IT to the CRO to the board, there might be a misunderstanding or a filter that is being put in place to make it sound like everything's in order. In some cases, and I would say in most cases, actually, the raw information of we have a problem, we need to fix this now, is something that's getting across the board, and they can make the decisions a lot faster than having that filter in place. So the good change, to answer your question directly, is we are seeing that cybersecurity person sitting on the boards of financial institutions now.
So from the management of the risk perspective, what's the practical steps? Who has to do what on a day-to-day basis? If a lot of it still is employee stupidity, but bad actors, I think you said, is a higher percentage now for the FI sector at least.
Yeah, and I think this is where the communication is a little bit better in the financial institution sector than any other sector, because the investment that's been put in place to make sure that we have the right securities, the right, we'll use firewalls, but any type of protection that's going to be from third-party bad actors is there. Now we're starting to get into more access management from the internal side of things. So the communication between IT and managers and how that access management happens also transcends over the human resource side of things, because human resources, I mean, even at Marsh, are controlling what is being given out on the first day one with the backing of IT. So now we're connecting the HR and IT together because of that digitization. When we start looking at what they have access to, this gets into, depending on different subsectors of confidential information and personal information, and how that's being transferred from one person to the next. So really looking at the IT, the communication with HR and the management is where we have to bring this all together. And that's not saying just the CRO or the boards having that communication, but also down on the ground level, the people that are on the ground on a day-to-day basis interacting with the customers. Because one of the questions that keeps coming up is talking about how they protect their information. We see these, we always click on these except for the privacy agreements. We check the box when we go into any type of website. The same thing's happening when you're a customer of a bank or any type of investment management, is what is the security of everything that's going on around. And I've seen, in terms of cryptocurrency, to dip a little bit into that. I'm not going to pretend to be a specialist in cryptocurrency, but how is it being protected and how is it being insured as well? And if there's going to be a hack that happens that takes the cryptocurrency, or it's lost, in some cases we've seen lost keys, how is that going to be protected? And all of these things come down to the communication from the top down to the customer.
Thank you. I guess that raises the question. I mean, this is the risk, but how do you quantify the risk and the potential loss exposure to it? What's the the process that has to be gone through to understand the impact on the business, and from the regulatory perspective, the impact tolerance, the hits you can take, and where you need to transfer, and setting a risk appetite, and an understanding of what the worst case scenario could be. We've got years of actuarial data for other lines for financial institutions. What have we got for the cyber risk area?
Well, I'd say we're in an exciting time now. We're starting to transcend and transitioned into understanding a lot more from a data standpoint what the losses may look like. However, with environments like the cyber risk environments and also the changing environments of the financial institutions, it moves the mark consistently. So right now, from a quantification standpoint, we've heard of some of these predictive modeling offerings that are out there, but really you're looking at the last 20 years of data to try and see what it may look like if that continues over the next year. So when you look at the quantification side of things, we can use property business interruption to then emulate some type of cyber business interruption. The only problem is property is very much in a silo, whereas cyber is a global network. It hits every part of the network, which then goes into looking at segmentation and segregation. So from a quantification standpoint, we are collecting a lot of this information because of all the different claims that are coming in, especially in the insurance world. We're seeing a lot of this. We see a lot more on controls, and there's starting to become a pattern in terms of the controls and what the losses might be in financial institutions. So that helps us to go back to, not to dip into insurance quite yet, but go back to the underwriters and talk about what the controls look like and what the losses may look like from those controls. The one thing I would suggest, though, when you're quantifying it, is get multiple different viewpoints. Don't take one model, don't take one perspective, and then go with it. One thing that we do is we use 7 or 8 different models at Marsh to make sure that we're going to be looking at this from different angles. And in some cases, we partner with third parties to get another type of opinion, because we want to make sure that we're looking at it in the right light. So when you start quantifying it, split it up into business interruption and the potential breach, whether it be confidential information or personal information. And then when you look at the network interruption, that's where you're going to start to get into a larger breakdown, depending on how large your organization is if you have multiple regions, multiple types of networks, you have to look at it and take it from the top down as the worst case scenario. What's the one thing that you don't want to go down? And if that goes down, what is the loss there? And then you at least have your parameters for the maximum. Then you can start to work on where you're going to get into that risk transfer potential.
And that's way before the transfer. So that's the sort of the normal sort of risk identification, assessment, mitigation, monitoring, and then risk appetite setting, impact tolerance, transfer piece, which is a nice lead into the insurance market piece, I guess, because of the transfer piece. But one question that's come in about this section is how much cover is available in the market, the insurance market, for trading losses arising from platform outage or the inability to make a trade. And my experience of the asset management claims world is that the customer who sues the asset manager because a trade couldn't go through suddenly identifies their losses. They would have invested in the top 10 trading funds or shares in the outage period. So there's a question about quantification again there.
Yeah, so with trading losses, I mentioned briefly, and I don't know if everyone caught it, but the investment exclusion on cyber policies does prevent a lot of these coverages when we start looking at the losses versus the gains that might have happened during a network interruption. You're trying to say, as you said, the top 10 would have gone through, but we didn't have a chance to do it. It really becomes hearsay and then he said, she said type situation. That being said, there are certain caveats when we get into a deeper dive. If you can make an underwriter comfortable going through the actual limits and what would be available from the total amount of risk transfer in a denomination is very difficult to come up with because it's different by every organization. However, we have seen carve-backs to the investment exclusion on rare occasions where there is an extreme amount of information provided, and it's best when we get into this type of conversations with the underwriters is to have a one-on-one with the primary carrier and those that are going to be interested to get them comfortable. And that creates that domino effect through the excess layers. So when we start looking at how much coverage is available, being honest, right now, minimal until you start to dive into the details that you want to provide them for trading losses. Now that's just the trading losses and that's due to the investment exclusion that's on every cyber policy. But again, we have seen carve-backs on one-offs to that exclusion.
I suppose on the traditional insurances, what we'd be looking at is there a breach of the professional duty of care to the customer, and does a professional indemnity policy cover it, which is very much a market of you get what you pay for. So there can be cover and there can't be cover depending where you go. We should probably move at hour into the insurance market side of things, the sales side. So the market's seen more claims. We've got an uplift in notifications. We've got war exclusions, and everybody's talking about silent cyber, and some people even know what it means. A number of issues which I'm going to ask you to talk to there, please.
Yeah, I almost don't want to dip into the war exclusion quite yet, as we know that Lloyd's is taking a quick look at it, but it is something that's being discussed, and there is a Lloyd's committee around the war exclusion, but it is something that I know is very important to financial institutions, because how an attack, because of 91% of the threats being from bad actors, what is that bad actor? Who is that bad actor? And, when we look at what happened in the US with the 6 different hackers being indicted for the NotPetya attack, now we're starting to put potentially a country, in this case, Russia, on the attack happening. That being said, nothing has really changed yet in that perspective for the war exclusion. When we start looking at the sound cyber side of things, it also ties into the professional indemnity that you were talking about, David, in terms of how is a cyber event going to trigger not only the professional indemnity side of things, but also going forward the liability on a cyber policy. Because if we start putting exclusions on the financial lines, particularly the E&O or the PI side of things, or the FI policy, we start to see that trickle into the cyber insurance as well. So this is the phase 3 that's coming in January 1st, is looking at the financial lines for that silent cyber. And just for anyone who doesn't know what silent cyber means, is that there's non-affirmative coverage on traditional lines of coverages that would be triggered potentially by a cyber event. Lloyd's has mandated the transition to affirmative or not covering it, exclusionary language on all traditional lines, which has put a burden on a lot of our clients to look at this in a different light. And as we go into phase 3, I think it will have a large effect on financial institutions. But then, talking about the claims and the payments and everything that's going on, I know there was another question in terms of the integrity of the cyber insurance market because of all the additional claims that are coming in this year. One thing to note is we've looked at this with a couple different syndicates in the cyber market, and this applies to all different industries, but they're looking at a cost of risk of 121% in 2020. And on the continuing patterns, if we were to see ransomware, which is the main trigger for this, we would see 139% cost of risk in 2021. So we are in a transitioning period for the cyber insurance market to make sure that it is sustainable, because we know this is a need for all of our clients. This is a need for all organizations, particularly for financial institutions who do typically buy large towers because of the risk that they have, not only from the data breach side, but also the business interruption that's becoming more prevalent. That being said, we've not seen any denial of claims that are coming specifically for the financial institutions on this, or any change in appetite in the claims handling. Yes, there's more scrutiny that's happening, but I think that's just because of the sustainability of the insurance market.
It's probably just worth mentioning there on the silent cyber and the claims piece. And we've seen, there's been some headlines about insurance not responding to cyber issues out of the US. You're smiling, Riley, and also am I, because the plaintiff bar has been trying to squeeze some cyber issues into property and other policies, where who knows, they may be right, they may be covered on a silent basis, non-affirmative basis, but underwriters are saying it wasn't the intent, and at least one of those entities had declined purchasing standalone cyber cover prior to their event. Any thoughts about that?
Yes. Having come from the US, obviously, being American, we saw a lot of these starting to creep in around 2016, but 2017, NotPetya really kind of put it into full swing and brought it to light. one of the hardest things about cyber, and I mentioned this in terms of modeling for quantification, is when you start to look at a story, don't take one newsletter that you read or two newsletters. You have to read a lot of things to get the true story and develop it. The war exclusions we mentioned before was something that was coming up and triggering on non-cyber policies, which everyone's familiar with, basically the case against Zurich right now on a non-cyber policy, but because they were putting cyber war exclusion and denial of claim, in a lot of minds, it was seeing as denial of coverage underneath the cyber policy. That being said, if this was going through the cyber policy, it would have been covered most likely on that particular case. And this has been discussed throughout the media. So it's confusing. And this is something we want to, as an organization and as a market in whole, to make this clear for every organization, particularly financial institutions that have multiple regions, multiple different areas that are looking at it. And we don't want this to be a domino effect from the US over into other regions such as the UK.
And there's a couple of other questions that are coming through just about, cyber insurance claims, the disputes, the payouts, the frequency. I think perhaps the best way to deal with a few of those is when we send a recording out of this session is to put a link to some of the more recent reports that cover this area, then people can have a look at those. In this cover piece, there is a question, what most asked by senior execs are fines insurable, and the insurance or the legal response is it depends, and a sub question of that, can we get definitive guidance from the ICO? So I'll jump in on this because actually when all this was coming through some years ago, I was part of a group that actually asked the ICO what they felt about the insurance of fines and penalties under their regime. And they completely ducked the question and said that they would follow the law of the land. So it does come back to that question of what is the law of the land and the insurance of fines and penalties. What's the position in the insurance market and what are they taking it at the moment, Brian?
If we specifically talk about the ICO and GDPR, which I think is where we're headed on this in terms of with the ICO's involvement, because they do have additional regulatory oversight. But with GDPR, it's a wait and see. And I think we've all been waiting for two large fines to be settled and agreed upon, which has happened in the last couple of months, both with the BA fine and the Marriott fine. And both those organizations do have coverage for cyber. So looking at how that's going to play out will dictate a lot of what we're going to see for different fines and penalties being covered underneath the insurance side of things. Now, to keep in mind, there are 26, 27 different countries that have different ICO ways of looking at it. So you have an ICO in each of those countries. And if we look at the Google fine in France, which was 50 million euros, they might take a different stance than what the UK might take on particularly the BA and Marriott fine. So it's a wait and see game with the GDPR. And I know that's not what everyone wants to hear on this call. I know they're looking for a definitive answer. So I will give you one little nugget. Takeaway is the defense side of things is being covered by the cyber insurance policies as far as we know at this point. So there has been no way that this has been denied in terms of the defense of that fine going through the rigorous year and a half, I believe both of these organizations have gone through. It has been covered underneath the cyber insurance side of things. So the things that we've heard throughout the market is that this is actually going to kick into excess layers rather than the primary, which is something to note when you start looking at a large fine being assessed against your organization, is when you go through this defense that may cost tens of millions, making sure that your tower is all in sync and it is file form is a crucial part if we start looking at the coverage for these types of fines and penalties after it's been assessed.
So a couple of sort of quite challenging questions. Does cyber insurance actually work? And I know from every other sector of insurance that we talk about the difficult claims or the argued claims and ignore the 90-odd% of claims that just get paid. So I'd be interested in your thoughts on that. But that ties into the systemic risk issue, the can insurance cope with the risks, which I guess you're going to raise supply chain, because a lot of my financial institution clients are with Amazon Web Services, AWS, for their clouds. The regulators are concerned about systemic exposure.
Yeah. Well, to touch on your first question, does cyber insurance work? I mean, not that I have to say yes, because that is part of my job, but it does. We see claims being paid out. I know that we were talking about it internally in the UK team, that there was a couple of recent payouts for a couple of our clients that we've been working on for several months. There's continual ongoing claims where we're getting those paid. And there was a report, I believe it was Verizon, last year, at the end of 2019, that said 99% of cyber claims are being paid. So when we start looking at going back to the non-cyber claims in the US and the media and what everything's being said, it's a good story. But really, if you look at that Verizon report from 2019, and I really hope they update it for 2020, and I'm hoping it's very similar, is 99% of claims are getting paid. So it does work. The part of the systemic risk in looking at the supply chain, or I should say the digital supply chain, and as I mentioned before, the sustainability of the insurance market. With financial institutions, you have multiple different digital supply chains, and then in some cases also physical supply chains, which we've started to include in some cyber policies. We may see a carve back in the physical supply chains just because of the underwriting aspect of that is very difficult. But the digital supply chain side of things does pose a systemic risk. And this was something in 2018, Lloyd's put out a cloud warning in terms of what would happen if AWS, Azure, Google, et cetera, were to go down. And one of the things that was discovered through that report is when you look at third-party clouds that are not those top 3 or 4, they actually use those top 3 or 4 in part of that digital supply chain. So when we look at what the systemic risk may be from a cloud standpoint, it still falls back to those top 3. And when we look at the sustainability, is do we want to have all of that supply chain collapsing the market, therefore no one's going to be having any coverage. So as brokers, it is part of our job to make sure that we keep it sustainable for our clients, and making sure, even though we're trying to stretch the coverage and get the lowest premium, making sure we're looking a little bit farther out than just the renewal, and looking at our wider book, and looking at not even just financial institutions industries, but a larger portion of what the insurance market looks like. And that really should go for every single broker to make sure that we're keeping this sustainable. As I mentioned, that cost of risk is starting to creep up into the point where we might not be able to keep it. And I know, David, we've talked about this too, but when you look at loss ratios that are occurring, and if we're seeing increases in premium, which we are now in a I would call it difficult / transitioning market, that change, if we start to see where the newer buyers are not actually purchasing, we actually lower the amount that's going into the cyber insurance market. And in some cases, we've seen some cut in capacity to save money going into 2021, which then actually creates a larger loss ratio when we start totaling this all up. So making sure as brokers that we're sustaining the markets by putting the right coverage, the right premium in place is important, and also communicating that to our clients on why we're doing that and having that conversation with them.
It's very important that the buyer understands the cover they have, because the risk setting, the risk appetite, the understanding the risk internally has to take it into account. I wanted to move into the sort of regulatory environment, but we had a question about what is the appetite of insurance companies to pay ransomware, with this considered to be paying criminals, and police have recommended that this is never paid. It sort of ties into our bad actors, emerging risks section, but ransomware is rife at the moment, and the regulatory piece, I mean, OFAC have recently come out. Do you want to talk about this section a bit?
Yeah, and I think particularly with OFAC coming out with what I would call a reissuance of the guidelines and you're supposed to follow, we've had several conversations, myself personally, with product leaders around the Lloyd's market to see how they're handling this and what's happening. So for anyone who doesn't know, what happens during a ransomware event is that if you have insurance, the insurer, the syndicate, would have third-party vendors, typically forensic investigators. Sometimes they would have a third party that specializes in ransomware demands and recovery. They would be the ones that would be doing the negotiating with the bad actors. They would have to go through, or they should go through, a series of reviewing whether it can or cannot be paid due to paying some type of terrorist or paying some type of country that is sanctioned. So this is going through all the process. Now, what we discovered, and I think everyone agrees in the cyber insurance market, is that we don't actually find out who the bad actors are most of the time. And when we do discover it, it's weeks, months, years sometimes afterwards. So we've not seen anything where there's a restriction after or post payment, but all the certain steps that have to go through. And I know there's a couple markets that go through a 7-step process to make sure that these can actually be paid. That being said, we will potentially see a slight carve back in the ransomware demand coverage underneath cyber policies, because we've seen the severity go from, say, 5 figures or £10,000 to up to 8 figures or £10 million. And in some cases in North America, we've seen 9 figures or $100 million being requested or demanded from these ransomware events. Now, on the flip side, if we decide not to pay the demand, wouldn't that affect the network interruption or the business interruption side? Yes. So that's not being carved back at this point. The conversations on the sustainability of the insurance market is being weighed out in terms of what's being paid for ransomware demands versus the business interruption or network interruption costs that may occur to an organization or to the actual insurance market in the end.
It's interesting because with Marsh Advisory, there was a report that the way you manage an event, not just a cyber event, but as a corporation, the way you manage an event has a greater impact than actually having an event on the long-term share price, the impact on the share price, which is quite interesting on, it's if you get it right. And I don't know, your team's talking to clients regularly about, practice runs, scenarios, running through lessons learned and what's the escalation process and how does that work? I guess that's a key part of understanding the risk and having it in place. A sort of question that ties to everything that's coming is, buyers are reluctant to purchase a separate cyber policy sometimes. And why do we think this is when the risk continues to grow? I have to say, from my perspective, on the traditional insurance lines and the overlap between a crime policy, a PI policy, and a cyber policy is something that we used to spend an inordinate amount of time explaining. But I think a lot of people do understand now. There was an issue over whose budget was it, and certainly a view of a number of CISOs that that the insurance premium would be better invested in improving systems than buying insurance this year. But this is now a board risk committee standing agenda item, as I said. Is it really the same? Do people
and I think with it being a board discussion, as I mentioned, 4 times a year or more in most cases now for financial institutions, the conversation's coming up more. There is a lack of communication still between IT, risk management, and the culture side of things, as I mentioned earlier. So when we start seeing the reluctance, I'd say 75% of the time, or 3 out of 4 times, it's typically due to communication breakdown. IT, yes, sometimes we'll look at it as a challenge to their ability to protect the company, which we don't want them to feel that way. I always mention this whenever I speak to a CISO or CIO, that this is really a safety net. We're not trying to sit there and protect everything and assuming that you're going to go wrong or something's going to happen because you're failing at your job. You have, in some cases, for some of the larger banks, millions of attacks happening on a daily basis. And they only have to get right one time, but these IT individuals have to be right all the time to protect against that. The odds are actually against that from being protected entirely. Now, I've seen some amazing protections going on where they've never had an event happen over 5 years, especially with the change in technology. Some of these large banks have kept up with it. Some of the smaller investment managements have actually kept up with it in the same sense too. But really, the communication and education is where it comes down to why we see this not being purchased on any level. If nothing else, it does give you the ability to access third-party vendors, as I mentioned earlier, to help respond. And that goes back to your comments with our Marsh Advisory article. Responding to it can actually save hundreds of thousands, if not millions of pounds in some cases, if you respond in a timely manner. Not only that, if you respond appropriately, your customers will see that you're actually doing everything on your side to protect and also respond to an event when it does happen. I think everyone understands the phrase, it's not if, but when. But I think even though customers understand that, they want to see that they're partnering with someone that can respond in a timely manner as well.
It just gives us, we've got through a lot. Bad actors we picked up already. And I love the phrase and think of the Hollywood raspberries, but where are we at the moment with what's going on out there? We've mentioned ransomware and where have DDoS attacks gone was one of the things we discussed.
Yeah, and it was interesting when we were talking about this ahead of this conversation. It's something that's always bothered me, and I was glad that you were going to raise this question and talk about it, because DDoS takes a lot of effort and a lot of energy and a lot of computers. If anyone's not familiar with the acronym DDoS, it's distributed denial of service. So the idea that a significant amount of messages are being sent to a financial institution server and therefore overloading it, forcing it to shut down. Now that takes 50,000, 200,000, 500,000, if you know what a botnet is, the collection of those computers together. But now you can do that with one email with the ransomware and the human vulnerability of clicking on it. They've become more efficient as financial institutions have become more efficient. As you've implemented more technology, such as applications to be able to transfer money to and from other individuals or other B2B, they've done the same thing. They've gone from botnets of hundreds of thousands of computers to trying to get a single email. Now, who's sending that email has also changed. We've looked at this as sophisticated programmers, hackers that are very over the top and understand all the knowledge. Now we have this script kiddies, as they're called, or individuals that can download a ransomware and then send it over. I remember one case I heard about was there was a ransomware sent out and it said, please contact, and it said insert email here. And that was the demand. And they didn't have anywhere to contact because the person didn't actually update for their contact. But it gives you an idea that they're actually just pulling it off the dark web and using this information or grabbing it from a site that is typically unattainable from our side of the fence.
And I've got to raise smishing.
Yes, and it's interesting because smishing is fun to say, and it sounds like you're just, you've maybe had a few before you say phishing, but smishing is the SMS phishing version. And what's interesting, I have gotten probably once a week a smishing attempt on my phone. I don't know if I signed up for something shady or whatnot, but typically from the financial institution, like you being used as the name. So I won't use any names to protect those organizations, but it would say XYZ Bank said that the transfer didn't go through. Please click on this link to make sure that it would go through, or your check's not going to come through from ABC fund or whatever. And it would try to get me to click on a link. And I've not deleted them because it's actually a great story when you have someone in person, whenever we can get back in person, to show how many of these are coming through. But it's for me at least once a week in the last 2 months. And it just shows you where this pandemic has caused a lot of people to try and get more creative in the way that they're actually going to be going after individuals. But I think it's unfair that they're using financial institutions' names, which then could come back as a reputational damage to your organization.
In fact, I got one this week telling me that the payment for my car tax hadn't gone through, and I had needed to press the link to re-enter my banking details. Looked very professional. It did look real, apart from the fact that the link it was going to was clearly not the right site it should be going through to.
Yeah.
Proliferation of malware, ransomware, the organized crime side of things, the technology that's behind it, the social engineering side is changing into, as you've said. I guess the world is developing. We've got a couple of more minutes of crystal ball gazing, if we can, please. Where are we going? What's the emerging risk? What should we worry about for tomorrow?
Yeah, I know we've talked about ransomware as an emerging risk. I think it's a risk that we know is here, but how it's going to be deployed may change in terms of, previously it was going through those phishing emails. We've seen more dedicated spear phishing, which means that they're attacking specific individuals. And I think one thing that's coming out outside of ransomware is the funds transfer fraud, or one of the things that I mentioned earlier is that man-in-the-middle attack. How are we seeing information being picked up in transit and being changed or altered so that information, or funds in this case, would actually be going to a third party rather than the intended party? And that's a big concern, because that supply chain that we were talking about and what's being used and those individuals. So financial institutions use other financial institutions to transfer information such as SWIFT to do that, and how that's being protected and different information being transferred, and the security of that information is, and integrity, I guess is the best way to put it, is now starting to come into question. And we have to make sure that this is has oversight and looked at it, because that man in the middle can change a lot of things and cause a lot of additional work and lost funds. When we look at the funds being lost, the recoverability of the funds is less than 10% last time I looked. So once that is gone, it goes through multiple different transfers after that. And therefore the trail starts to go a little bit cold. I think from that, those are the top two emerging risks. Social engineering, which, we start looking at the deceiving of an individual to then send it over, is very similar to man in the middle, but a little bit less sophisticated. And this borders on what you were talking about between the crime and the cyber side of things. There's voluntary release of funds by an employee of the organization, but if they're deceived to do it, but it was done through an email, where does that fall? Does it fall underneath crime, because it's technically not a theft? Does it fall underneath cyber because it was computer, but technically there was no actual taking of the money, or it was just an email that was sent? So basically a communication form that was computer. So it starts coming to question, and we haven't heard much about social engineering lately, but I think that's only because ransomware has really overtaken the news and media from that perspective. Social engineering, there's been a lot more training in organizations and a lot more steps been put in place, such as two-step thought process or three-step for authentication, depending on the amount of money that's going to be transferred.
So where are we? 2 minutes to go. I think we've run through pretty much all the questions that came in. You just talked about the ransomware and the impact on the perceived likelihood of financial recovery. That's an area, I guess, that for financial institutions' perspective, they'll be involved in from both sides, because they'll be involved in tracing and recovering as well as being targets. So that's an interesting area. But I think we're there. So, on the horizon, ransomware, more ransomware, and train your staff, bring them up to date, get your systems in place. The funds transfer frauds, and the digital side of that is our prediction. Digital supply chain, and with my traditional insurance risk hat on, the hard supply chain issue as well, where your vulnerabilities are, where your concentrations are, very much a regulatory thing on that side as well. So that's the future.
Yeah, and I think just to add on to that, Dave, with the digital supply chain, we could almost put that into the emerging risk. So it's no longer looking at your controls. It's looking at several third parties' controls and making sure that they adhere to what you need to protect your organization, or as any of these funds transferring, making sure it's protecting those funds or the data that's being passed back and forth for your customers. So that digital supply chain, while technically we can't say other organizations are a risk, they are the same as human vulnerability and employees may be.
Great. I think we're there. That's our hour. There's so much more we could talk about. If anybody has any other questions that they want to send individually, then we're quite happy to have a look at those and answer those individually. If anybody wants to pick up with Brian or myself, just get in touch directly. Thank you, Brian, for your time and for answering my random questions in random orders, showing that you and your team really know your stuff. Thank you. And everybody out there, let's hope that some kind of lockdown relaxation happens soon and we can have a Christmas. Thank you very much for attending.
Thank you.